My first guest does see Warsh, at least his headline says, as something of a hawk. I want to bring in a Yardeni research president at Yardeni. And so here's the thing. And I think this is when I was reading your piece, it stood out for, I think, a lot of folks with respect to the task force. The task forces will share an objective. The Fed is clear-eyed about its mission, fit for the purpose, and focus on the future. They are likely to begin work in the next couple of weeks and conclude with the year end. And the fact is that they want stability. They want stability, which is what I guess all Fed chairs want.
Sure.
But you came away thinking that Warsh was more of a hawk than a dove.
Well, more than was suggested by his speeches and commentary before he got the job. I mean, clearly when he was interviewing for the job with the president, he sounded pretty
You think he did
dovish.
some bait and switch already, or did he?
The president must feel that way, and hopefully the president won't react adversely the way he did with Powell. But it sure seems that it's contrary to what he told the president.
I see it differently. I think he's setting everything up to do everything he told the president, but he can't do it with the current guidelines. Are you surprised, though, at the way the market's reacting today?
Well, you know, the markets, I think, keep having these little hissy fits and dips, and they get over it very, very quickly.
Very quickly.
Very quickly.
I wish I got over a cold that
well,
quickly.
it's earnings. I mean, the earnings have been fabulous. I call them fabulous earnings momentum, FEMO.
So you mentioned the possibility of a June swoon. If we don't get a June swoon, it looks like right now we won't, coupled with things like oil coming down rapidly.
Sure.
What does that mean? Could that signal even a stronger summer, maybe a summer rally?
Well, look, I like your scenario. It's a good one, and it's plausible. And I mean, I'm using 8,250 on the S&P 500 by the end of the year.
Did you say last week somewhere that maybe you hadn't been bullish enough?
Yeah, because the earnings numbers just continue to get stronger and stronger. But all in all, the earnings are continuing to drive the market higher for sure.
One of your notes this week talked about because of the circumstances out there, maybe looking abroad. Stay home, but go global. What exactly, this is one of your great charts that you had. You see opportunities out in the rest of the world?
Yeah, the rest of the world is definitely cheaper on a valuation basis, on a PE basis, than the United States. And I think we've seen emerging markets doing awfully well. I like EMXC, which is the emerging markets excluding China. China has not been a good place to invest. But of course, that includes some plays on artificial intelligence like Korea and Taiwan.
Yeah. I mean, that's the irony, I think, of all of this is that a lot of it's still base technology. People say, well, relative strength is doing well. Yeah, technology is driving that. Emerging markets are doing well.
Yeah.
Technology is driving that. Technology really is driving everything.
Right.
And this is the part of, it takes me to one of your pieces this week. The Roaring '20s, bring rockets and Mars into the equation. It just feels like that's a booster, if you will, no pun intended.
It's a booster, but you also have to be concerned about top of market kind of events when we get all hyped up about something and we're really predicting where revenues and earnings will be in a few years rather than what the immediate outlook is. It's something to be concerned about.
How far should we go out? Because it feels like there could be something of a new paradigm. I feel like a lot of traditional Wall Street have missed this rally. Thinking about, well, what's the ROI in the next 12 months instead of maybe the next 24 months?
I think that's a good point, and that's why we've been focusing on calling this thing the Roaring 2020s. It certainly feels that way. We're actually the 7th year into the Roaring 2020s, and you get 3 more years. I think by the end of 2029, the market will be discounting something like $500 a share for 2030. Multiply that by 20, and you get to 10,000, and technology undoubtedly will be among the winners.
Gold coming back. I want to ask you about this. No, this isn't for you. I'm sorry. This is for our next guest. I want to ask you about gold. Feels like gold is bottomed here.
I do think that. It did break through its 200-day moving average, and then it found support at 4,000. I'm arguing as a technician rather than a fundamentalist. And I think that was a bottom, and I think it's going to gradually move still higher. I'm using 5,500 by the end of the year.
Still? Okay. Before I let you go then, your biggest concern right now, just maybe a periodic bouts of over-enthusiasm?
Well, I just met with a lot of our institutional accounts here in New York City, and I'll tell you what their biggest concern is exactly what you say, that we're building too many data centers and the demand's not going to be there. And maybe one of these days, one of the hyperscalers, instead of reporting cloud revenues up 40%, it'll be 10%. The market will freak out on that. So it's a concern.
Yeah, that's why I say next week, I think, in Micron,
yeah.
There's going to be certain companies that have to prove that this thing is still intact.
Yeah, absolutely.
Yeah, hey, great stuff.
Yeah, my pleasure.